I kind of pitched it for why you should partner with a preferred equity partner. Our side of the business, why should a sponsor offer that? It's a tough question, to be really honest with you. As a sponsor or a manager of a preferred equity investment, it's not terribly profitable. Syndication is much more profitable. So I don't think it's something that, everybody's going to wake up tomorrow and want to jump into this business. The margins are a lot smaller. We're doing it because we see it as a way to grow our business and be synergistic and eventually grow into one of these institutional shops that are, putting out $200 million of preferred equity. So that's our incentive, but it's definitely not going to make us rich in the meantime.
Got it. Okay. That makes a lot of sense. Thank you. Okay. So, obviously I wanted to kind of make this actionable and give Rob the opportunity to show his models. So I made a screenshot of it here. Obviously, if you can share, I make sure I give you permission to share your screen here. Let's see. Yeah, if you want to share your screen, I'd love to see kind of a quick walkthrough through your model. Maybe if you have, a deal that you have in there, and you can just kind of show how you look at it and the different tabs and everything. So, because I know a lot of people on this call are, people that do this and want to learn more about it. So I think that would add a lot of value to everybody.
Absolutely. Yeah. So I can go ahead and share anytime.
Yeah. So I'll start my share. There you go.
Okay. So let's see. Hopefully everybody can see the screen just on the summary tab here. Okay, perfect. So like we discussed earlier, and I apologize, this is raw. I just went into our files and pulled a random model out. And this is a model that I didn't even do. This is my analyst, was the one who underwrote the deal. So he could be wrong. I could be wrong. He could have written a note in here that is not for public eye, but that's totally fine. So let's dive in. So this is the inputs tab that I had mentioned. So actually I'll zoom out of it first. First, I just kind of want to show and show you that within the screen that you're seeing here, obviously it's too small to read, but this here are all the inputs that we need to really fully understand and evaluate a deal. So it's not very much. Like I said, we're going for bang for your buck here. So it's not like you need to go through a million different tabs and input all these different assumptions. We're trying to keep it as simple as possible. So let's start from the top, and from the top left, and then we kind of go like we're reading a bit. So the very first thing that we typically do when we get a new deal is we obviously need to know what is the pricing expectation. So we ask the seller or we ask the broker, we say, what is the pricing guidance? What is the whisper price, right? Whatever terminology you're using. And we'll put that actually here. So we'll say, oh, well, they want, 13 million, right? And so that way we remember, okay, this is actually what they want. And then when we actually play with different purchase prices, we are, we can tweak it and then not forget, oh, what did they want? So that's step number one. And then number two, like I mentioned, is the unit mix. Now the unit mix, often you can either copy it from the rent roll, from the offering memorandum, or even online, just going to apartments.com is, we sometimes have to do that. So here are the market rents. And I'll point out that these market rents are then calculated for an annual gross potential rent here. And then similarly, the pro forma rents, which obviously backed by rent comps, something that you should definitely spend a lot of time focusing on, are calculated here in terms of your stabilized gross potential rent. And then from there, we head through pretty much just an income statement, starting with the gross potential rent to other income loss items such as vacancy, bad debt, and concessions. And, something important that I want to note is, so what we're doing here is so the one little nuance here is we're not just copying, what I'll do is I'll quickly find the financials for this deal. So operating statements, and this is their T12. So what I'm not doing is I'm not copy and pasting the market rent calculated here in the T12. The reason for that is we have a mismatch in a way between rent roll and T12, because a T12 is a 12-month, period of time. It's a historical, picture, whereas a rent roll is a snapshot in time. It's just one day. It's just that day's rent roll. And so the problem we have is rents change over time. And what we want to do is we want to have the most up-to-date numbers, right? Rents are up, rents are down, whatever it is. So what we do is, again, our gross potential rent here is calculated from the unit mix that we input as to where we see rents, roughly speaking, today. And then what we do to offset that, because you're likely to have a difference. For example, this T12 is showing 1,717,000 in market rent. We're showing 1,758,000. Okay, so we're not just going to give the sellers credit for free money that they don't deserve, right? What we do is we offset that with an appropriate loss to lease. So whereas their loss to lease is only 15,000, which gets them to a net potential rent of right around 1.7 million. Well, in our model, we've got a slightly higher gross potential rent and a slightly more negative loss to lease, which in the end gets us to 1.701703, which is to the dollar the net potential rent in the T12. So yes, we did a good job on this one, and I take no credit. So that's kind of a nuance there that I think is helpful to understand and can maybe avoid some confusion. So, and again, we're paralleling the T12 and the stabilized columns, because it's, number one, super important to understand where we are, where the seller is, and then build our assumptions moving forward from there. So, here we're raising rents ever so slightly, bringing loss to lease to our typical 2%, normalizing vacancy. So, we're just kind of comparing what is and then making projections about the future. Same thing, we move now down to the expense side of the operating statement. We've got our T12 that needs to be inputted from the T12, right? And this is pretty much just kind of copy and paste 101 or 201, depending on what's going on. But you get those copy and pasted, and then we use certain metrics, certain guidelines to underwrite on a stabilized basis. I don't want to get too much into that, but basically it's through experience, through underwriting many deals, through working with your property management team to derive budgets is where you can create value and get more accurate on the expense side.
So see here, so you don't make any assumptions of like reducing utilities or other things. You're kind of just keeping them as it was in the T12 there.
Yeah, this here, just looking at it, looks pretty vanilla and standard for us. Our payroll looks a little bit high, but it looks like this is a smaller property. So the payroll budget's a little higher. We're typically somewhere around $1,250 a unit as a base case assumption, but we're a little more expensive. Looks like the note is, this is based on the OM. So we took the OM at face value. We're not afraid to underwrite to lower utilities and get aggressive with reducing expenses. I think that's one of the best ways to find a great deal is find a deal that has too high of expenses, because I think there's more opportunity there than finding a deal that has low rents and where you're not paying for it in the price, right? It makes no sense to buy a deal where you can raise $200 on the rent if you're, paying for it by paying a 4 cap, right? So I see that happen less for expenses, baking in, the implied value creation through expense reduction is less prevalent in valuation. So now we've got through the expense side, and now we've got NOI and our cap rates. So here you can see the underwritten cap rate based on the T12 is a 5.5, but because we're actually reducing expenses based on T12 versus stabilized, not by much, but we're reducing them, the underwritten cap rate is just over 6. And so the difference there is the way that we look at an underwritten cap rate is we look at the in-place revenue minus our stabilized expenses to really get an understanding of what the real income in place is. Because, for example, let's say this is a mom and pop shop and they have no management fee. They hire their sister for 25 grand. or well, 250 grand. That's good for them. You know, for 25 grand on the payroll, now all of a sudden the seller's cap rate is 7%. Oh, this is a fantastic deal, 7% cap rate. Problem is, it is, you know, that's not your expenses. Your expenses are needing to be adjusted based on how you would run the property. So it doesn't really matter in terms of a cap rate calculation what how the seller's operating the property. So let's now move on to the assumptions. So we took care of it really quickly: the unit mix, operating income, operating expenses, and now onto some of the assumptions. So I'll you know, breeze through this stuff. Cash reserves, you got to have them. I wrote an article about it. It can be a complex topic, but for now we'll keep it simple. The way that we typically look at it is we're either reserving up 1 month's worth of operating expenses and debt service, or 2 months worth of operating expenses and debt service. And we make that a determination whether it's 1 or 2 based on the risk of the project. Usually the determining factor is whether the deal is a bridge loan deal or not, with a bridge loan deal being more risky and therefore we want more reserves. Now, these are our debt assumptions, pretty straightforward, plug them in. And then this is the interesting piece. Again, this is what I would say, you know, many models look the same and many models act the same. Where they're the most different is the stabilization assumptions. So everybody, the way they calculate renovations and they calculate rent increases is all very unique. And so again, I'm a simple guy, and the way that I tried to think of this and implement this is as simple as possible. So what I did is I created some more variables. I chose stabilization months, which is basically the amount of months that we need to implement our business plan. And specifically implement our business plan, what that means is a couple things: to get our revenue from in place to stabilized. And that includes taking the vacancy. Let's say we're buying a deal with high vacancy, 30% vacancy, and then the stabilization is 24 months. It's going to take 24 months to get the vacancy burned down to 7, let's say. So that stabilization months is the time it takes to implement our business plan. And the way we calculate in the pro forma is linearly. So we take, you know, let's say we're doing $100 rent increase, right? What we'll do is we'll chop that $100 by 24, and every month we'll just add linearly. So we're just marching linearly from in place to stabilization. Very straightforward. Obviously in real life, it doesn't work like that, right? You're going to have some months you renovate 20 units, some months you only renovate 10. But for modeling, I don't want to exactly try to model reality. I just want to give myself a good indication as to whether this is a good deal or not a good deal, without overcomplicating things. So stabilization months, right? And then the budget, how much you're spending, and then the going in vacancy rate. So the reason why we chose to have a going in vacancy rate specific input rather than just saying, well, you're at 4%, just start at 4%. And the reason why is we've learned our lesson the hard way, and we understand that there's a very common dip in occupancy upon takeover. When you buy a new property, especially when you're buying a turnaround play, right? If you're buying a deal that has $600 rents and your business plan is to take those rents to $800, that's a material change, and you're likely requiring a re-tenanting of the property, you know, a fundamentally different tenant base. And that doesn't happen overnight, and that certainly drives up your vacancy. So even if the vacancy on the rent roll today is 10%, you know, if you know you're coming in with a heavy turnaround, you might want to do 20% going in. So that's another piece we added to allow us to kind of play around with the going in vacancy rate. Similarly, if I want to renovate 50 units a month, I'm going to actually have to create artificial vacancy, because as it stands, let's say this deal's sitting at 5% vacant. We have 120 units at 5%. We only have 6 vacant units at any given time. So you're restricted in that way. So you might want to actually create vacancy, and so that you'd underwrite that way. So I think these things, when you break it down that way, are simple components and make it an easier way to actually defend and support your business plan. Because if an investor that you're working with, or, a partner is questioning you and saying, well, how many units are you renovating a month? Or, you can kind of ballpark it just based on the numbers here. For example, we're doing 73. You can say, oh, well, 73 over 24 months, right? That's only 3. Specifically on this deal, that's a bit unique because I believe the way that we underwrote the deal was, this is during COVID times. And so with COVID, agency lenders are requiring a reserve holdback. And so this reserve is $1 million. And so we took that $1 million that the lender would hold back for 12 months. And we would say, when that comes back to us, instead of just giving that back to the partnership, back to all the investors, we'll actually take that and improve the property. So we're actually going to wait 12 months to get that money back and then renovate 73 units. So that's actually 73 divided by 12. So that's 6 units a month. Still very conservative in my opinion. So again, it kind of lays things out in a more clear way. All right, we're almost done. So stabilized assumptions, simple stuff. This kind of mostly goes back to the income side, but there's also, asset management fee, property management fee, and then you calculate your property taxes based on a millage rate as well as an assessed value. And, property taxes can be extremely complex and they're all over the place. So it's really specific to the county. And so, if you're in a county where it is crazy, you really should rely on a property tax consultant like we do. And then these are some scary inputs here that everybody talks about, the annual rent growth and the expense growth. So you often see, 3% rent growth, maybe even 4% rent growth. And, maybe you don't think much of it, but here, let me just show you the quick difference. So with just inflation, which just assumes that your income and your expenses just go up at 2%, which is roughly inflation, this deal is showing a 13% return. Now, if I take this number and do 3% and keep the expenses low, which is a common way to underwrite, not wrong, but a common, now it jumps to 15.4. So you boost it up by 200 bips. If you go to 4%, now you're up 17.5. And so this isn't wrong. I mean, we're talking about a deal in Austin today. I mean, it's kind of abstract, but Austin, Texas, right, is a tremendous growth market, and you absolutely can achieve 4% rent growth there. So it wouldn't be necessarily wrong to do that. It's just, what's your style and how do you want to underwrite? And so our typical preference is to, unless we absolutely must, we just want to leave rent growth out of our projections, and we just want to see if the deal can support itself just on the merits of it alone and the business plan. That's really, really hard to do in a top growth market where everybody else is underwriting to 4 and 5% rent growth, and you're just trying to do 2%, because people have pricing power at that point. They're going to solve for, let's say, the same return metric, the same return bogey that you have, but they are growing so much faster. So it's very hard to win deals that way. So that's just something to be aware of. And, if you're a passive investor and you're looking at a sponsor's underwriting, you could potentially kill the deal just by changing this one number, right? They might have 4% rent growth and you say, well, let's just see what happens at 2%. And you do that, plus you change the exit cap rate, it can completely change the deal. Another nuance about rent growth is the time period. So if you're underwriting a 5-year hold or a 10-year hold, I would argue that your rent growth assumption should be different, because there pretty much has never been a period in history where rents have grown unabated anywhere at 3% for 10 years, right? Things go up and down. You have a year that's flat, you have some negative rent growth, and you have some positive rent growth. So it's, the longer your hold period, the less inclined you should be to actually want to factor in rent growth into the model, because it just becomes more dubious. So, and the last nuance on rent growth is particular to our model here, which is that we suspend any of this rent growth here, this inflation, during our stabilization period. So for the first 24 months, as we're working on our business plan and we're really working hard to get to these goal rents, we're not just growing rents as well on top of that. So that's another nuance. So in this deal particularly, we have no rent growth for the first 24 months. and then we, grow at 2% from here on out. So, then you got other escalators, you got vacancy, simple stuff here. And then I want to get to terminal cap rate, which we already touched on. And basically, this is where you input this very important number. And just want to give an example. Obviously, this is an overgeneralization, and I'm not arguing that this should be a 6 cap deal. But if you look at a 5 cap, it means the exit price is $131 a unit. If I change it to a 6 cap, it brings it all the way down to 190 units. So I just lost 20,000 a door in value. I think it's a couple $1 million just by going from a 5 to a 6 cap, which may not seem like a big difference. So always need to sanity check your exit cap rates and, have it ideally supported by sales comps. So I'll leave it at that. We just, in record time, walk through pretty much every input in the model. So it's just that simple.
Go back to your cap rates based upon your expenses. Just scroll down a little bit on the left there, because you have kind of the 5.53. That's your based on the T12. Then you have a 6.02 and a 5.44. What are I guess I'm much clear with the two.
Sure. Yeah. So yeah, good question. So the 5.53 is the T12 one, and honestly, we don't care about that one at all because it's not real to us, right? We want it based on our expenses. So this is the real one, the underwritten cap rate and DSCR. So this one here now is a return on cost measure. And this is potentially, if you're going to take one thing away from this webinar, a return on cost is the most important metric of all of underwriting. So sorry to bring it up at the very last second, but this is the most important number. And so what a return on cost is it's kind of a smarter cap rate. And so the way it works is you take your pro forma NOI. In this case, it's 780. So, our business plan takes the NOI at 710 up to 780. So our return on cost takes 780, which is our pro forma NOI, and it divides it by our costs associated with achieving our business plan. And what are our costs? Well, there are our purchase price and our capital expenditures. So if I'm buying a deal for $5 million and I'm doubling the NOI, but it's going to cost me $5 million in renovations to double the NOI, I need to factor that cost into my equation of, is this a good deal or not? Am I getting a good return for spending this $10 million in total? So it's the same here. So I've got a little bug here because of the interest reserve being factored in, but that's not a real cost because it's going to be returned to me. So I need to just get rid of that. So when I get rid of that, I get a 5.83 return on cost, which if you can see the formula, it's F40, which is our NOI, and then it's our purchase price, and then it's our CapEx calculations. So it's literally that simple. Our pro forma NOI divided by our costs. And as you can see, a 5.83 return on cost, okay, is it good or is it bad? And that's kind of the next question. So like I said, it's the most important. If you could only have one number about a deal, it would be the return on cost because it's the least able to be manipulated number. You can't rent growth on this number because it's an untrended return on cost. It's simply when you stabilize, this is your number. So it's untrended. And then similarly, it's unlevered. There's no debt that we're layering in here. So we can't pump up our numbers through, low interest rates and debt and this and that. It's an unlevered number. There's no debt involved. So that's why it makes it the truest metric. Now, the piece that you are missing from just knowing this number is you need to know what the market cap rate is, because is a 5.83 return on cost for this deal good or bad? Well, if you're going to sell at a 6 cap, that's bad because actually you're destroying value. It cost you 5.83, percent to build these cash flows, if you will, and you're going to sell them at a valuation of 6. So you just destroyed value. Now, at the same time, if you're going to sell this property at a 5 cap, well, you created value because you were able to actually create an income stream on your cost basis at 5.83%. And now you're able to sell that income stream at 5%, which is going to, take you up to a higher value than your cost. So that's the math there. And the final piece, and then I'm done, I promise, is risk and time. So there's no time in this formula. And that's why we don't just underwrite and look at return on cost and call it a day, right? We have time, we have growth, we have risk. And so what you need to understand is, a 5.83 return on cost is not the same as a 5.83% return on cost that took you 2 years and a ton of risk, right? If I could just buy it and do nothing and get that, right, that's obviously a lot better. So I highly recommend you guys start focusing on this number and just paying attention to it. And then you get reps and you can see, oh, well, it made sense here. It didn't make sense here. And you'll pick up these nuances along the way.
Very cool. Awesome. Yeah, I don't think many people use return on cost in their models, and it's awesome to include that. So very good. So that was kind of like the base model there. And then you want to just show the pro forma, that's kind of the annualized, that's the return per year then, or that's like the deal.
This is just, the income statement with the pro forma, starting with revenue, expenses, then we hit NOI, and then you've got below the line cash flows, like asset management fees, and then debt service, and then you get to free cash flow. And then from free cash flow, then you've got metrics, valuations, cash on cash.
Do you have your annual CapEx reserves above the line or below the line?
Above. So here.
Got it. Yeah.
Yeah. Cool. So I'll also just point out, since we got on that topic of return on cost, here it's labeled stabilized yield on cost, same concept. So what I like about this is you go to the unlevered and just the purest number, which is that return on cost, and that's here, 5.83%. And then you go to an unlevered IRR, which is similarly unlevered. So it's, more pure, if you will. But what the difference between an unlevered IRR and your yield on cost is you're actually now factoring in the sale into the calculation. Whereas the return on cost, we were just simply taking our pro forma NOI and dividing it by our purchase price and CapEx. Now with the unlevered IRR, the reason why you're getting a 9% unlevered return and not just your 5.83 is because, like I said, when you sell at a 5 cap, you're creating value. And so that your return, if you bought this deal unlevered, you would get, roughly speaking, 5.8% cash flows. But then when you sold, right, you would have a windfall, and that would get your annualized returns up to 9%. And then we take it up to the next level, which is levered returns, right? So we went from yield on cost, unlevered IRR, to now levered IRR, which obviously just factors in debt. So, that's found on this here summary page, which is really just focused on touching on all the high points of the deal.
Very good. Awesome. Thank you. And we are already kind of over time. I don't know if you have, Rob, you have a few more minutes. There were a few questions that came up. I'd love to maybe answer those.
Sure.
Let's see here. So there's a few questions. So somebody asked what RUBs are, and that Danny actually answered that. So that's basically just billing back utilities to the tenants, splitting it out if they're not metered. Jeff asks, can you clarify if market rents are what is actually being collected on the rent roll, or what the rent should be based on comparables?
Yeah, good question. So in terms of our definition, in terms of this model, market rents are, it's hard to define, but they are the property's market rents. So it's not the market rents in the sense that market, but it's, reasonably speaking, what should this unit at this property be renting for? And then there's often a discrepancy between what market rents are and actual rents, because let's just say the tenant moved in a long time ago and they've been slowly seeing a rent increase, or maybe the tenant negotiated a discount or something. So that discrepancy is reflected in loss to lease. And so sometimes when we underwrite, let's say we are provided with financials that are cash accounting, and they don't show vacancy, they don't show loss to lease. All they show is one number, and they say, this is how much rent we collected. This is cash in the bank. So then we have a couple approaches. We can just go off the rent roll and just plug in exactly the actual rents as they are on the leases, or we could use kind of general market rent numbers and then kind of create our own vacancy and loss to lease based on what we understand about the property. So you just need to really fit the way that you do this based on the deal. So typically speaking, though, what we do is we'll come up with the market rents often based on just the rent roll. And then we'll, again, where we get precise is where we offset it with that loss to lease to make sure that we're not overstating or understating the real deal income of the property.
Very good. Thank you. I think that was the only questions that were there. If anybody else has questions, put it in the chat window. And I'm going to stop your sharing here. Share my screen here. Okay. Let's see here. I don't see any other questions. So that's really, thank you so much for sharing all that. That's awesome. That's why I called it advanced, because I knew it was going to get into a bunch of topics here that may not be kind of thought of a lot, but you shared that really well. So the next thing, so Q&A, we had some of that. I think this is your contact information I found on your website. So if anybody wants a copy of that spreadsheet that you have, what's the best way to connect with you?
Yeah, so if you're not on our newsletter list already, the best way to get your hands on the model is to sign up for our newsletter list, which you can do so at lonestarcapgroup.com. So head over to the website. You'll see some links to click to subscribe to the newsletter, or download the free model. Check it out. Let me know what you think. Happy to collaborate. Somebody just asked, does the model like this also pertain to smaller multifamilies, 5 to 20 units? 100%. You can do 1 unit with this deal, or with this model. I encourage you to edit it and make it your own if that's what you need to do. But it works totally the way it is on smaller properties. Very good.
Yeah, so I encourage everybody to sign up for the newsletter and get a copy of the spreadsheet for yourself, for sure. So I was going to give you a book away, Rob. I felt like I usually do this. So there's going to be a question that comes up now. The first person who emails me the answer and your mailing address is going to win this book. I'll personally go and buy it on Amazon for you. So here's the question. Well, let's see if I can get it to work. Here we go. So you have to pay attention to get the answer. But you talked about operational shock. What does that mean? So give your best explanation in a few words. Email that to me. Here's my email address, and I'll send you a copy of that one. But I need to get your mailing address as well. So not like a couple of times ago, I actually said anybody who sent me the answer got the book, so that cost me a bunch of books for this one. So I'll get that out to you. So what is operational shock? Send me an email on that. And the last thing I wanted to just share is I do some real estate coaching. If anybody is looking to learn more about underwriting or anything else, I can take some students probably towards the end of this year. Just send me an email, and I would love to talk to you about that. And that's what I had for today. Rob, do you want to say anything else before we end today's session?
Thank you so much for having me. Had a good time. Anybody on here, feel free to reach out if you have questions. And like you said, highly encourage you, if you're going to ask the question, okay, what's the next step? I really want to dive in. I really want to do this. It really is my book. That's what I wrote it for. And I really feel strongly that it's going to be the best thing, step-by-step wise, to get you, going in the direction that you want to go. So highly encourage that. And yeah, that's about it.
Find it on Amazon. Get a copy of it. Well, thank you so much, Rob. I really appreciate your time today. It's a lot of fun, and I will send everybody this recording so you can kind of go back and revisit some of these things that we went over today. So thanks again. Everybody have a wonderful evening, and I will talk to you soon.